Welcome to this video tutorial. And in this video, I'm going to show you specifically on how to go about it. You know, the first step to beginning your analysis on these indices. Now, today we'll be looking on Volatility 25 index, which is one of the synthetic indices on deriv broker. I'm going to leave the link below. Should you need to register an account, you can just click on the link below if you want to. So let's begin. The first step to starting your analysis, I believe a lot of people, they will love to start by using a smaller time frame. I'm okay with that, but to be more accurate and to save yourself trouble from losing your money or getting hit here and there, you must understand when to enter, the timing, what time frame to use in order to understand your analysis. So the first thing that I always do each time I'm about to start analyzing, I love to start on a daily time frame. So I'll go on a 24-hour daily time frame so that I understand where the market is, what the market is doing, you know, everything. I'm going to have a better aspect on the market. Pardon me, it is now these days, this daily trading view implementation for daily or synthetic indices has been a little bit slow. So let's wait. I'll just have to refresh it so that we have so we are on a daily time frame. So right now, the daily time frame, which is a 24-hour time frame, I am able to tell where the market is coming from. So the first thing that the market did was it broke the structure. All right. After breaking the structure, we can see that the previous level of a swing high was already broken. So here, this structure was broken. The market came and created another consolidating structure or another market type condition. So this structure was broken. The market went up and created a new high right there, or a new higher high. Since an uptrend is created by the series of higher highs and higher lows. And then again, we can see that this higher high was broken. The market came and created a new one right there, together with another type of market condition, which is a consolidation. Another one was created here. So we can see that this high again was broken, which was a sign that the market was in an uptrend. So we can see that the structure again was established right there. Now, according to what we are looking at on a daily time frame, I am able to tell the point of interest where the market may be heading, because number one, the advantage of you starting your analysis from a daily time frame is that you'll be able to tell where the market is coming from. Number two, you'll be able to tell where the market currently or presently is, which is here. Thirdly, you'll be able to tell where the market may be heading next, or also to create a reverse or a change in a trend. Fourthly, and most importantly, you are not going to be deceived, because on a small time frame, other people may be selling, but on a higher time frame, we see that the market is showing some more push-ups to the upside. So the next thing that I'm going to do is that I will have to use the past to determine the future movement of the market. So in this case, I am going to mark the entire structure. Now, somebody may say, but why the heck are you doing this? I am trying to mark the highest high of this consolidation and its lowest low. That means you are marking it properly. So the next thing that I'm going to do, for those of you who don't know about order blocks, I am looking at the order block that the market used to break below this structure. And in this case, I'll be trying to look for a bearish order block. I'm going to mark it like that. And then it is that candle. I'll mark it like that. You can try and see the course the videos on order block. So I have marked it like that. So also I would even name this one as my point of interest. Okay, point of interest. Why have I done so? If you look carefully what is happening right here, you discover that after this last bearish bullish candle was formed, followed by the bearish movement, which took out this low by creating a new low here. After that, we will be able to tell that it was now the force, some kind of force that was used here to issue a drop to the downside, overpowering buyers, all right, because the market is influenced by two forces, all right, buys and sells. All right, so here retail traders believed that they needed to buy low. All right, by the way, we are on a higher time frame. So as a result, there is a more significant reason people would have bought it thinking it was a level of support, which is more dangerous. However, market makers managed to break below and then created a new low to the downside. Further, again, they tried to push the market up. Later, they found that there was a strong force of the selling within the area of that order block. Again, the market dropped. So here, I am looking at the reason why the market is going to start dropping at any time. However, I am not going to enter just now. So after I understand what is happening on a higher time frame, the next thing that I would do is to go on a 4-hour time frame to start confirming my analysis, because I'm trying to do top-down analysis. As you can see, on a 4-hour time frame, the market is showing some consolidation because the point of interest, which is also an order block here, is a significant level that is telling us that this point of interest is going to hold, and we can also use it to sell or to place our entries. However, it is not going to be done so fast, because if I try to mark this entire structure on a 4-hour time frame as the way it's supposed to be, we have the highest high there, like that, and also the lowest low below. All right. Now, within this major structure, there are also other consolidating structures, which looks like this. All right. And each structure, each time the market breaks a structure, it will always leave the order blocks. All right. Order blocks will always be there. So what next will happen here? We can see that the market is now showing some rejections, because we know that it is in the presence of the most powerful order block, which the market had used to break below this structure. All right. And each time frame has its own order block. So where these two blue lines are, it is symbolizing the bearish order block on a daily time frame. But if we try to do this, we even change the color for this. We give it red. We will see that we are trying to mark also the order block that belong to a 4-hour time frame. So after you mark everything, you discover that the market reached and touched the bearish order block line, or the blue line, which were drawn on a daily time frame, but it never reached the 4-hour time frame. So now, where is the future of this volatility 25 index? All right, because you don't just have to enter the moment you see it reaching there. All right, if I take you again more closely, you will discover that right here we have a bullish order block which the market had used to break outside and above that structure when it went up. So what may happen is that the market may create a retracement, reaches this level, bounce, and then go back, because the market cannot just change the direction minus creating patterns such as double top or double bottom or head and shoulders. All right, so if I go on a 1-hour time frame, we are going to have a chart that looks something like this. All right, and as you can see, this line I drew was for the 4-hour order block. But at the same time, just like I told you, each time frame has its own order block as well. So here we have a bullish order block, this last red candle here. All right, you can check the videos on order block. So what you are seeing here, you can see that there is also some forces that prevented the market by creating this bull candle here. because it is an order block, and the market makers can also use, all right, this same order block here, which I had drawn, to bounce and then push up like a continuation. Why? Because the principle states that after the break of structure, like this huge consolidating structure, with its internal smaller structure inside, when it gets broken, the principle states that always trade to the direction of the break of structure, which means the previous known as demand supply, after it was broken, there is a higher possibility that this same supply, previously unbroken supply using the order block can be turned into a demand by changing the character of it being acting as a supply to becoming a demand. Why? Because the market now has broken this supply and it has become invalidated. So the next thing that you're supposed to do now to start preparing your entry is to switch to 30-minute time frame, and it looks something like this, all right? Because the market is fractal, which means whatever that happens on a higher time frame also happens on a lower time frame. So here we can see what these guys are planning. The market can come, bounce there, and then create a continuation. So what you are supposed to do is to be patient and let everything play out. You don't have to rush to place your entries. So if I was you, I would wait for the market to reach these levels, which are on a daily time frame. All right, this blue line and that blue line there, they are representing the bearish order block on a daily time frame. All right, and on a daily time frame, we can still see that the market is still pushing up. So whatever the market is doing right now here, it is just trying to create a bullish flag pattern where it will go like this, bounce here, and then create a continuation to the upside. So you can now start preparing your entries on a 15-minute time frame after you finish analyzing. So on a 15-minute time frame, we can see the channel that the market is trying to create, which looks something roughly like this. Okay, so this channel also is carrying a significant understanding or reason to as why this is happening. So they are trying to use the order block, which we are drawn with these two red line, bounce on it, and then continue up by also breaking that higher high right there. So once that happens, the market will now aim to start preparing to sell once the market reaches this zone. So it is very much important that every time you are doing your analysis, you must ensure that you start on a higher time frame to prevent a catastrophic situation where you may enter a fake move, which will present to you as if the market is buying or selling, when in reality it is doing the opposite. So top-down analysis is important. Now, it is not just enough. You must put into consideration such as time frames, market structure, order block, supply and demand, break of structure, change of character. That is a type of smart money concept that you can use to trade these indices. Thank you so much for watching this video. I will see you in the next tutorial.